question of the day is how should investors sorry, I was looking at the wrong one. How should you react or what should you do during periods of heightened volatility? So kind of an open-ended vague question, but a lot of different ways we could take this. So Lee, what are your thoughts when you hear, if someone asks you, it's like, hey, the market's been volatile, like what should I do?
One thing that comes to mind, and this is kind of establishing some foundational points, is volatility. Volatility doesn't always mean negative. I think people associate volatility in a negative way.
We're like dropping off a cliff.
They attribute volatility to the markets are going
struggling
down.
with that word.
Sorry, I'm tired. I mean, it's normal. Okay, I mean that's one of the very first things that we talk about with clients is volatility is normal. Now, it's more pronounced in certain times, and we're going to talk about that a little bit later. But we're not market timers. Day traders love volatility.
Sure.
I mean, they're playing the ups and the downs. But if you're a long-term investor, which our clients are, and we're long-term managers, you stay the course. I mean, you dollar cost average. That's why you're putting in your 401k plan.
Yeah,
every
I mean,
month.
volatility can lead to a lot of opportunities.
Absolutely. I mean, it's volatility, in my opinion, just presents great opportunities to educate. Mm-hmm. I mean, and again, I just go back to the point of typically when a client comes in asking about volatility, it's not it's in a negative way. I mean, they think things are bad. John, what are your thoughts?
Well, I just think that's a great point, and I also add every situation is a little bit different. Sure. Volatility hits people a little bit different. So I'll give you an example. Last April 1st, the Trump tariffs came online, right? And it created massive volatility, if you remember, right? And negative volatility. The market went down about 22% from top to bottom in that short 3-week trading period because of fear of the tariffs destroying the U.S. markets, right? Well, when that fear subsided, the market quickly recovered. In fact, the quickest recovery ever in market history. And this is the point. Had you in that time frame reacted based on emotion, based on fear, based on the market, based on volatility, and you would have gotten out, let's say the market's down, because you never time it perfect, right? Volatility happens, and then you panic and get out. So that means you're already down when you decide that you can't handle it, and then you miss out on the recovery. And that's the danger of like trying to time the market, trying to, and I guess some of the things like ignore the noise, I think is a big way to advise people. Don't let the heightened, when you're watching TV and the financial channels and everything is just a massive story and it's going to end the markets as we know it and everything's going to be bad. Just ignore the noise, stay the course, don't panic. Know what your risk tolerance is, what you're able to handle. Rebalance to the target if that's something you need to do. I also say, like, in the middle of a massively high market, we just hit. I'm going to say a word that Matt is called the Dow. These young guys know the S&P more, but the Dow hit 50,000, right? And we've hit it again, and so it dipped back down. Now it's back there, so record highs again. This is a great time. If you're worried about volatility, if it does make your stomach upset when, like last April or this year's, already a few days, then this is a great time to rebalance your portfolio and take some profit off the top and rebalance into safer things. So know when, understand the markets and pay attention to them when they get to these high levels. If you're out of balance, rebalance. But for the most part, ignore the noise, stay the course.
If you're overly worried about volatility, you're probably not invested appropriately.
I would agree.
Exactly.
The perfect portfolio is one that you can stick with, both in good times and bad, right? What's hard is, we talked about this on the show, and I talk about it a lot, is there's two things that drive investors' emotions and decision making. It's fear and greed. So finding a portfolio that you can stick with when everything's going extraordinarily well, and you don't get greedy and start changing things, trying to be more aggressive to take advantage of that. And then the opposite's true. You don't get fearful and do something. And finding that portfolio that you can stick with both in good times and bad is, hopefully you're positioned for the volatility on the front end so that when things get volatile, that doesn't necessarily mean your portfolio is is moving or doing things that get to a level that you're uncomfortable with, right? Like you kind of expect to know how you're positioned and what you should expect when things get dicey. But yeah, volatility can create a lot of opportunity. You know, ideally you're positioned well for it on the front end. You don't wait. I think what you said is absolutely true. If you've done well, like if you've been doing better than you need to do, and the market's giving you more than you need, like I say greedy. People are gonna be like, why do you keep calling me greedy?
Yeah.
But like don't get greedy. Like take advantage of that and say, okay, we're going to lock these in. We're going to make sure we're repositioned now. If the market continues to go up, great. But you'd rather rebalance now, lock in those gains, get yourself positioned so that whether it's this year, next year, or 5 years from now, there's a market sell-off or we have a correction or something, you know, you can handle it and you can ride through it. If it happens before you're positioned appropriately, you know, it's too late and you're kind of stuck and you have to just ride through it.
As an old farmer once told me, pigs get fat, hogs get slaughtered. Don't be a hog. Is that what you're saying?
That's well said.
Okay, thanks.
You know, I'm going to not disagree with you, but this podcast, we're going to banter a little bit.
The banter's good.
I did not think last April was volatile. I thought maybe a couple years ago when
2022.
When every day it seemed like we had 1% and 2% swings.
Sure.
Up. I mean.
Oh yeah.
To me, that's volatility. Where it is just, I mean, you walk in and it
depends on how you're defining volatility, for sure.
Correct.
Because like if you're defining it by, you know, if you're just looking at like the VIX, which is like the fear index.
Correct.
It's
Right.
It's like, well, the VIX definitely spiked, right?
In April.
In April.
It did.
But I know what you're saying in terms of that kind of longer lasting, the up and down moves of just kind of these, you have 2 and 3% up days, 3 and 4% down days, and just these big wild swings. It wasn't really
Which we've experienced more of that in this year.
Correct. I mean,
this year.
you know, so from 1st of May through the end of the year last year, market straight up, theoretically.
Sure.
There's no volatility in that market, in my opinion. Yes.
But that goes back to the negative connotation of volatility, which is what I fell right into. But that's the point of like, we think of most people think when you hear volatility and the market's going straight up, the volatility index is usually really low when the market's going straight up because that's the fear index. Mm-hmm. And fear is only when the market's getting sold off. So I look at it like volatility equals fear, even though, you know, that it's kind of the way I've looked at it. But I look at like we're going to have these types of markets on and on and on. And if you are, to Matt's point, which is the best point, know what you can handle, know what your risk tolerance is, know what your expected outcome is, what you need to be taking in risk, and then try to stay that course. And once you're in that, don't panic and don't worry about the volatility, especially the negative side.
Well, to your point, so this is one thing, you know, like with, you know, standard deviation is a measurement of
volatility. That's where I was going with that,
And so people think volatility as only negative, but you can have a very high positive standard deviation, and
which would be
highly volatile, but you may not, which would mean it's highly volatile, but doesn't necessarily mean it's highly negative, right? It just means it's moved a lot.
Correct.
So the price has moved a lot, so the volatility is high, the standard deviation is high, but it's not down a lot. So it's kind of, I don't know, tomatoes.
Well, and oftentimes when we're doing these risk measurements, it is more of a measurement of, I think we get hung up on when we're doing these risk scores is basically how much can you let it go down.
Right.
But truly, to Matt's point, it is more of a how much can you stomach these wild swings. I mean, these, you know, one standard deviation is so much either up or down. You know, I mean, I've got clients that oftentimes get as nervous about these just crazy swings more than they do.
Well, we're all human. You have 3 days in a row and the market sold off.
Makes you feel a little squeezy.
4, 5, 6%. I mean, every one of us are sitting there saying, "Here we go."
Yep, exactly.
Here we go.
Sure.
You know, and then It's the market will humble you because you think you can't listen to your gut.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC.